Saylor's Strategy just sold Bitcoin for the first time in 4 years. After half a decade of never sell, the biggest corporate Bitcoin holder on the planet hit the sell button and the market flinched. So is the conviction trade finally cracking? Not really. And the real story is more uncomfortable than that. Here's where we are. Bitcoin is sitting around $71,000, a near 2-month low, capping roughly 3 weeks of slow bleed. Ether is soft, below $2,000. Two things drove today's leg down: Strategy's disclosure and Iran halting its talks with the United States. That second one is a macro headline we'll leave to the markets desk. What matters for crypto is how little it took to move the price. Because look at the actual sale. Strategy sold 32 Bitcoin, about $2.5 million worth, at an average near $77,000, to help cover a dividend on its preferred stock. 32 coins, against a treasury of more than 840,000. That's a rounding error, under 0.004% of the stack. They sold into last week's strength, above where Bitcoin trades right now, and they've said that for every coin they sell, they intend to buy 10 more. This wasn't capitulation. It was plumbing. So the headline, Saylor sells, is mostly noise. The signal is the reaction. A symbolic, immaterial sale shoved Bitcoin toward a 2-month low, with leveraged longs getting wiped out within the hour. That's not the behavior of a confident market. That's a market hunting for a reason to sell. And yet, capital isn't leaving crypto. It's rotating. While Bitcoin and Ether cooled, Hyperliquid, XRP, and Stellar all caught a bid. That's the pattern we keep flagging on this channel. Money moving between narratives, not heading for the exits. Underneath the red tape, the structural story actually got better. In the US, the CFTC opened the door to regulated crypto perpetual futures, clearing both Kalshi and Coinbase, with Coinbase becoming the first US exchange cleared to offer global crypto perps. And Citigroup put a hard number on the tokenization thesis. It projects the tokenized securities market could grow from about $17 billion today to $5.5 trillion by 2030. With heavyweights like the DTCC and the New York Stock Exchange's parent company moving on-chain. Slow moving, but that's the institutional rails getting built while the price chops sideways. A few more worth your radar. On Solana, a new proposal, SIMD 547, would burn far more SOL per transaction, potentially lifting the daily burn from a few hundred coins into the tens of thousands. Co-founder Anatoly Yakovenko has signaled support, though for now it's still just a proposal. On security, CertiK says May's exploit losses fell about 90% from April, down to $68.3 million, the calmest month in a while. But calmer isn't safe. Gnosis Pay hit an active exploit today, briefly telling users to pull their funds before pledging to cover all losses. And IREN, the Bitcoin miner turned AI infrastructure player, closed a $3.65 billion financing to power its cloud deal with Microsoft, the clearest sign yet of miners pivoting hard into AI compute. So back to Saylor. The sale itself was nothing. What it exposed is something. A market where the longer-term build, perps, tokenization, deeper institutional rails, keeps moving forward while the price reacts to almost anything, even a rounding error, by heading lower. Strong foundation, fragile floor. That gap is the whole story right now, and it's the thing to watch as we move into June. We cover crypto on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.